The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Alasdair Macleod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair Macleod of the Gold Money Foundation, and with me today I have Ron Hera in New York. Ron, welcome.
Thank you for having me.
Tell me a little bit about, is Hera Associates or?
Hera Research. So
Research,
I publish a newsletter that covers natural resource stocks specifically. I make what I call an intellectually honest effort to cover the entire resource spectrum, which of course is impossible. But I focus on resources where I believe the values of those commodities are rising because of supply and demand fundamentals. So I cover a lot of gold and silver stocks. In fact, that's the majority of my portfolio, but also uranium, platinum group metals, some copper. It just depends on which resources are most attractive.
Now that's a pretty wide brief. In looking at that, to what extent do you look at economics as a driver for commodity prices?
Right. Well, I tried to cover all of the major approaches. So I don't specifically use technical analysis, but I do look at a lot of charts. I take a macroeconomic analysis point of view in order to determine what I should be looking at and where I should be looking for investment opportunities. And then within that, I'll look at specific companies, and that's the fundamental analysis. So I'll do macro analysis and fundamental analysis, and then go to also using some technical analysis, but I don't make investment decisions based on that.
It's tough times at the moment, though, with the Huey, if that's how you pronounce it, looking like it's in very, very bad shape, with gold, admittedly, gold and silver not performing at all well as we speak. But how do you see the outlook for gold and silver mines with such a bad performance in the market? Is this something going to turn around soon, do you think? Has it got to the point where gold mines are so undervalued that they're an absolute steal?
Well, the irony in this situation is that the gold price hasn't really come off that much in percentage terms. I mean, we hear about the nominal fall in the gold price. Let's say it's down $25 or $100. In percentage terms, that's really not a significant move. But in contrast, the share prices of the gold miners in particular have fallen quite drastically. In fact, the majority of the stocks are 50% or more below their 52-week highs. And that's a remarkable situation given that the gold price hasn't fallen significantly in percentage terms. So what that means is that there are compelling value opportunities in the gold mining shares. Now, my approach to this is to avoid companies where they may lose access to capital as a function of the share prices being depressed, and avoid situations where I might be diluted as a shareholder because of the need to issue a lot of shares in order to raise sufficient capital to move ahead with exploration programs specifically. And what that means is that I'm focusing now on more mature companies that are already in production or very near-term producers, and specifically on companies with compelling cash flow situations where they have a strong balance sheet and where I can see a significant potential increase in resources, particularly in production, as well as in ultimately the cash margin. So I'm focusing on low-cost producers with attractive balance sheets.
Right, so that's, your formula really is to go for strong fundamentals, notwithstanding that the company concerned might be in the earlier stages of its life. You're looking at avoiding the company getting into a situation which it cannot escape from due to market circumstances.
Oh, absolutely.
Yeah.
In fact, I would say that normally I invest across the whole life cycle spectrum of companies, but today, because of the depressed share prices, the investment portfolio is shifting towards the producing companies and towards the cash flow situations. I see it as an opportunity to buy cash flow at a discount.
Yes, and I can see, I mean, certainly at this conference, there are sort of people wandering around, I think looking slightly bemused. It is not as busy perhaps, as I expected it, but then I probably didn't know what to expect. Do you find that people generally have lost interest because of the poor performance?
No, I don't think so. I think that there's the interest that I'm seeing on the part of just people that I've talked to at the conference and potential subscribers and new subscribers. It's basically the same. I think people are more cautious and more concerned now about the outlook for these stocks. But I don't think for the segment that we're looking at and for this focus in hard asset investing, I don't think the interest has really diminished very much. I think people are maybe hesitant to make investments, but certainly the interest remains strong.
Yes, and I think fortune favors the brave in this case. I remember from previous bull markets in gold that the prices in the early stages of a bull market for the metal itself rewarded you with huge gains in many of the shares, and you needn't necessarily go into the real early exploration risk end. Do you think there's going to be, once the conditions improve for gold, presumably you would see that there would be really some very, very good gains to be had?
Yeah, so let me say that exploration stocks are the majority of the junior resource companies, and the majority of them will probably not find economic resources. And as a result, most of them would not end up being good investments in the long run, although there might always be money to be made if they have a discovery or some good drill results. That's why I'm focusing more on either production track companies that have a defined resource, or companies that already are in production where a lot of the risks that exist in the mining business have been mitigated. For example, permitting risk or execution risk in the mining engineering and so forth. I'd also say that as the market has declined, we in fact have been repositioning many of our investments into companies that we think will rebound most vigorously from the market low. So whenever the low does occur, and we think in terms of sentiment, the low has occurred, and I've said as much. But in terms of the actual indices or where the shares will actually bottom, or if we're bottom bouncing now, it's a little unclear. It's hard to time the market. But as we've approached what I would say is a low in market sentiment, where I've been told by my friends who are traders that everyone's out of the gold stocks, that hedge funds are blowing up with their short strategies already, that there's no one left to buy these stocks. So when you hear things like this, you realize that, well, it can't really get any worse in terms of sentiment. So that's got to mark some kind of bottom, somewhere near the bottom. So as we've gone into this period, what we've done is we've sold stocks where we had gains, and we've repositioned those profits, and we also have sold losers, less developed companies with lower margins, companies with higher production costs, and we've liquidated a lot of investments that aren't going to rebound vigorously. And we've positioned ourselves into companies with strong balance sheets and strong earnings, so that as sanity returns to the market, and I mean in terms of PE ratios, for example, as investors realize that these stocks are undervalued and come back into the market, at that point, we will be well positioned in stocks that will rebound vigorously. And we've seen the same thing happen before in 2008 and 2009, and we did very well. And I expect that's what will happen again.
And companies mining silver, is that an area which has anything you think that's interesting?
Yeah, I am very interested in silver. I cover a lot of silver stocks. I own a lot of silver stocks in my own portfolio. And I think that the negative sentiment has created great opportunities in the silver producers. And for example, I cover in my newsletter, I cover First Majestic. I recently did a report on Fortuna Silver. These are two companies with strong growth stories. And it's not well understood that mining is a tough business. It's hard to build mines. It takes a lot of capital expenditure. It takes a long time to drill off resources. and to actually get into production and have a profitable operation. So when you see a company like a First Majestic or a Fortuna where they've been able to do this repeatedly, where they've built 2 mines or 3 mines or 5 mines, those are companies with the kind of track record where if you have an opportunity to buy the stocks when they're undervalued, you'd probably be well advised to do that.
Yeah, and management really is everything in these companies, isn't it?
Oh, absolutely. So in terms of that execution track record, that goes directly to management. I mean, that really is the key, is following the people, both on the exploration side and also on the mining side.
Looking at the metals themselves, this week we have seen the sharp deterioration of the situation in Europe, with Greece unable to form a government, the French having elected a socialist president, and the response from gold has been to fall along with the rise in interest yields for European or Eurozone government bonds. This is a reverse, if you like, of the logic that one would normally expect out of the movement of gold at a time of enormous uncertainty and systemic risk. How do you see the price of gold behaving in this? Do you think this is going to continue, or do you think at some stage the market will wake up and realize that gold is not a risk asset but actually is an insurance policy? How do you see it developing?
Well, I think the current pattern will change, and I would say that the dollar currently reflects is a mirror image or reflection of the euro. Rather, it's the opposite. We're seeing euro weakness, dollar strength. As the dollar strengthens, we see the Dow fall, we see gold fall. We've seen this before. It also reflects a flight to safety dynamic, where the dollar is the largest currency. These are the deepest in terms of liquidity, the treasury market, for example. So when there is a flight to safety, we've seen this happen before, where the dollar will strengthen and treasuries will become more valuable. The problem with that is that pattern is not sustainable in the long run. And we've seen it start to break down before, and we're seeing that pattern reassert itself now. But in the long run, I expect that pattern will break down again, and precious metals will reemerge as a safe haven.
Yes, but if looking at the dollar, there is only a brief moment in time, presumably, before the dollar starts weakening, because the dynamics in the US economy are really looking pretty grim, or certainly as far as the currency is concerned. So I would have thought that the dollar being a safe haven as an argument has really got a very, very limited lease, as it were. And presumably, the dollar is going to start weakening quite substantially, perhaps as soon as the pressure maybe refocuses towards the dollar from the euro, which at some stage, presumably it will. We know that Europe is a continuing crisis, but all you need is maybe a slowdown in the bad news from Europe before other people turn around and think, where else are there the weaknesses in the global fiat money system?
Yes, I think in terms of the flight to safety dynamic, I think there are short-term practicalities as far as salvaging investments or cash from the Eurozone versus a long-term strategy. So I think that the rally in the dollar, as previous rallies have been, is temporary. The worse the news from Europe gets, the longer this will continue with the dollar. But of course, the dollar itself is also fundamentally flawed. In fact, that was the topic of my presentation here at the conference. I used the analogy of the 1988 film The Matrix, where the protagonist Neo is offered a choice of a blue pill where if he takes it he can believe whatever he wants to believe, versus a red pill where he can experience reality. So in the United States today, I would say simply that the blue pill is looking a lot better.
We're all on the blue pill.
The blue pill is looking very good these days. With the slightly lower unemployment rate and certain other data like the increase in retail sales and so forth. And there are actually bright spots in the economy, like the shale oil and shale gas, for example, although I would point out that those depend totally on high oil prices, which also encumber the economy at the same time. But there are other bright spots. Silicon Valley, for example, is doing well. There are even pockets of real estate that are looking up relative to the overall nationwide real estate picture. And of course, real estate is a regional market in the United States. So having said that, I'd point out in terms of the red pill that almost all the economic data really breaks down on further analysis. So if you look at consumer credit, or if you look at unemployment, or if you look at inflation or GDP, all these numbers break down, and really the overall trend is still negative. The underlying trend is still that the U.S. economy is contracting. The overwhelming evidence is that there has not been any recovery, and ultimately the recovery meme is a Wall Street delusion, and that is what the Federal Reserve policymakers and the folks on Wall Street and the folks in Washington, D.C., this is what they want to believe. And so they've taken the blue pill, but the rest of the economy has taken the red pill.
And it's an election year, of course, for a new president. So this is a blue pill year in that sense, I suppose.
Well, they certainly will continue with the current, what I would refer to as propaganda, with respect to government economic data and the news media interpretation of that data, that I expect continuing good news from the mainstream media. But the underlying economic data, the underlying reality of the United States in terms of the federal budget deficit, in terms of federal debt, in terms of the actual unemployment situation, if you look, for example, at the ratio of the civilian population in the workforce, you see that that has contracted dramatically and that has not recovered at all whatsoever. So even as the employment rate has somewhat improved from, let's say, 9 to 8.1%, the reality is that fewer people have jobs than before, and those jobs haven't come back.
Indeed. No, the problem, I think, with unemployment statistics in the US is they are somewhat confusing because you've got so many measures, and there's the wide measure, which John Williams of Shadow Stats, I think, is showing at over 20%, somewhere.
About 22%, yes.
And that includes people who statistically would, I suppose, be not looking for work or any other excuse not to be included in the main, or am I being cynical?
Well, the headline number, the U3, doesn't include marginally attached or part-time workers. So if an individual loses a full-time job and then gets a job flipping burgers or slinging burritos at a fast food restaurant, they're now considered employed, even if that's a part-time job.
I suppose in a sense, that's fair, but presumably there's a sort of break-off. I mean,
well,
if
there's
someone
a certain rationale for it, but if you look at household income, you can see the underlying reality.
Exactly. And I mean, you're mentioning household income, I think is a very important point, because really for the last decade at least, household income has really been buoyed by realizing money from the increase in asset prices, particularly, housing.
Yes.
And it is that has supplemented people's spending. And of course, with that asset bubble having been destroyed, that is no longer there. So the recovery into something which hopefully would be more normal consumption is hard really to see where it's going to come from on any lasting basis.
Oh, that's right. I mean, the consumer spending that existed prior to the recession of 2007 is not returning in the foreseeable future, despite the higher retail sales numbers. So indeed, it is true that household income has declined for a couple of decades if you adjust it for inflation. And that was masked by the housing bubble. And now the underlying reality has asserted itself. The bubble obviously has burst. So from this point, the question is, where's that spending going to come from? And it can't come from expansion of consumer credit. It's been reported that consumer credit has recovered. But if, in fact, since approximately 14 million Americans are unemployed, enough people have gone back to school to improve their job skills, or at least to seek shelter during the recession so that hopefully by the time they finish school, they might be able to get a job, that in fact consumer credit numbers have been distorted by student loans. If you take out the student loans, there's no recovery in consumer credit. With retail sales, if you actually adjust it for inflation, you find that inflation alone can account for the majority of those increases in retail sales number, or the recovery rather, in retail sales numbers. And to make matters worse, given that the unemployment picture hasn't really improved, if you really look at the underlying data, what that means is that people are paying more for the same goods. It's not an expansion of the consumer base, nor is it an expansion of purchasing of more goods and services. It's actually consumers paying more for the same goods. So you have a kind of a stagflation situation here, where you have a stagnant economy, or actually a declining economy, and at the same time you have inflation.
Which is a worrying combination. So to sum up, the economy is on some sort of minor recovery, which doesn't look really as if it's going to go anywhere interesting. Gold has probably got the wrong message from what's going on to currencies generally, and it is only a matter of time before it begins to get the right message. And stocks in the resource area are substantially undervalued, significantly. What's the superlative one would use? They are so undervalued. This is the sort of once in a decade or once in 20-year type valuation.
Well, I wouldn't say that, because they were equally undervalued only in 2008. So if we compare today, but I would actually go further and say not only is the so-called recovery in the United States anemic, it's been manufactured by government deficit spending and monetary policy.
That's a very good point.
And if we actually remove the effects of monetary policy and government deficit spending from the economic data, what you find is that there's not only no recovery, but in fact a continuing decline. Now, I have been told by my Wall Street friends that the absence of recovery is a gold bug delusion. And my contention is it's really just the opposite, that in fact the recovery is a Wall Street delusion.
I think that's a very good point. The last thing before we finish, how do subscribers find you? What's your website? HeraResearch.com. It's HERA research.com. And you would welcome anyone to come and visit your site and hopefully subscribe for your very interesting letters. Ron, thank you very much indeed for taking time out to speak to me.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.